Hello and welcome to the Alston and Bird weekly webinar series, Making the Most of Tax Reform. Today's session is an update on qualified opportunity zones. Today's program is being recorded. At this time, I would like to turn the conference over to Mr. Scott Harty. Please go ahead, sir.
Thank you very much. Good morning, everyone. Thank you for joining us again this week. My name is Scott Harty. I'm a partner in the Federal and International Tax Group with Alston & Bird, and this morning I'm joined by Branson Lee, who's a Senior Associate in our Financial Services and Products Group. And this week, Branson's joining us to review a topic that seems to be all the rage these days, the new Opportunity Zone rules. So we will get into that shortly. Just real quickly, as some housekeeping, prior presentations that anyone might be interested in are always available on our website. You can always email us if you need information or have any questions about that. We can access slides and the webinars as well. And we also mentioned last week we are expanding this series and sent out an email, I believe, yesterday listing our upcoming topics. So next week we'll touch on SALT issues and then benefits, and then we're going to turn back to some international topics for 4 weeks. So I hope you can join us for those. So just to level set and give you a little bit of a roadmap as to where we're headed today, what we're going to do is Branson's going to review just what the legislation says and what opportunity zones are and what the benefits to investors might be, and then address the rules to qualify as an qualified opportunity fund. And then towards the end, we're going to touch on current trends and issues. So as we go through the presentation, please ask any questions. You can always email those to us. Just click the Ask a Question on your screen, and that will come directly to us, and we can get your question, and we'll definitely respond to it. So let's get started. I just want to introduce Branson. Branson advises REITs and other alternative investment vehicles on tax and securities matters related to structuring and formation and mergers and acquisitions. And he's also counseled fund sponsors and developers on structuring funds and investments in qualified opportunity zones. So Branson, I just want to thank you for being with us and presenting on this topic. And with that, I'm going to turn it over to you.
Thanks, Scott. You are right. Qualified opportunity zones do seem to be all the rage these days. And it's been a fun ride so far. So as you already outlined, I'll just start by sort of giving an overview of what the statute is and what the benefits might be and how to qualify. I'll try to do that quickly, but just want to lay some groundwork before we get into some of the more interesting issues and topics towards the end of the presentation. So qualified opportunity zones, the program was enacted to encourage investment in low-income census tracts. Those were identified by the states, so all states have opportunity zones. They are not necessarily blighted areas and run down. Some of them are already sort of ripe for development. In total, about 12% of the country's land masses is covered by these zones. So one way of looking at it is that there are tons of investment opportunities. Another way of looking at it is that, some fund sponsors, I think, are struggling to find ways to deploy the capital in some of these zones that might be more rundown. The benefits to investors, so that's sort of the ultimate goal here, is to get investors these benefits for investing in the zones. So number one, investors invest eligible gains in a qualified opportunity fund, or QOF. They defer those gains by investing in the QOF until the earlier of December 31, 2026, or when they sell the investment in the QOF. It's benefit number one. Benefit number two is a basis step up for the investor, equal to 15%, up to 15% of the original amount of gains invested in the QOF. And benefit number three is exclusion of the appreciation in the QOF interest. So talk about each of those in a little more detail. So on the deferral, and to make a qualifying investment in a QOF, and this is really for any benefit, the taxpayer must invest the eligible gains, which is generally capital gains, in the QOF within 180 days of the transaction giving rise to the gains. The 180-day rule, there's an exception for partners and partnerships that we'll get into a little bit later, but basically, if a partner in a partnership has a gain that shows up on its K-1, then that partner's 180-day period starts on the last day of the partnership's taxable year when that gain arose. So for example, partnership has a gain on February 15th of 2019. Partnership does not invest that gain in opportunity zones. On December 31, the partners in the partnership will have a fresh 180-day period during which they can find and invest in a QOF. So we are in that period right now for many partners, and I would imagine that lots of the individual investors who might consider this program have gains that are showing up on K-1s, and so until 180 days after December 31, there is probably a huge population of people that are sort of within their 180-day period from gains recognized by partnerships anytime last year. Deferral, as I said, lasts until 2026 or the sale of the investment. The basis step-ups, 10% basis step-up after a 5-year hold and another 5% after a 7-year hold. To get the 5%, so the basis step-up is 10% of the deferred amount and 5% of the deferred amount. So you invest 100, you get a step-up of 10 after 5 years and an additional 5 after 7 years. That 7-year benefit and the 5, you have to have held before December, for the 5 or 7 years before December 31, 2026. So for the 7-year benefit and the 5% step up, investors will need to invest before the end of this year. There's chatter about that being changed in the regs, but the clock is ticking under the current rules. Exclusion is sort of the third benefit and the big one. To get the exclusion, an investor has to hold its interest for 10 years or more and sell the interest after 10 years. We'll talk about some of the challenges there, but an investor in a QOF that owns a QOZ business entity, subsidiary that owns property, the investor actually would have to sell the interest in the QOF. So it can create some challenges on exit that we'll talk about a bit later. The example I can...
Branson?
Yeah.
Can I ask you just a quick question? On the deferral of the gain, when you say qualifying for deferral, you can defer until December of 2026, or if the interest is sold. So what do you do, or what are people thinking about, or how can managers be thinking about that recognition date? If you've rolled that over and you've got a tax liability coming due, but maybe the investment isn't liquid yet, how are people thinking about that?
Right. Yeah, we've had a fair number of questions on that issue. You've got investors pouring money into these QOFs today. The project manager or fund sponsor has no plans to liquidate in 2026 or create a liquidity event in 2026. So on December 31, 2026, all of those partners recognize the gain that they originally deferred, and then come April or September, they pay that tax on that gain. Some fund sponsors and managers are considering refinancing around 2026 and trying to distribute some of those proceeds to investors to sort of soften the blow of that recognition event. That is, I don't know if it makes sense from a business standpoint to refi at that point, and that's great. That could soften the blow. But I think the bottom line is the investors are just going to have to plan for the recognition event.
Okay.
So there's really no silver bullet there.
Yeah. It's a ways off, but 7 years down the road.
7 years deferral isn't bad. Worth planning for. So.
Yeah.
There's a slide on the sort of example of the benefits. I'll just breeze over that for the sake of time. The one point that I want to make sure is clear, though, is that this statute does not require that easiest by example, if you hold $10 million of stock and you sell all $10 million and you recognize a $1 million gain, you can invest just the $1 million and sort of get the full benefit of deferral. So unlike 1031, where you sell $10 million of real estate and you would have a $1 million gain and you want to 1031 that into a new property and you've got to put all $10 million into the new property, here you only have to put the $1 million gain in. So a little more flexible in 1031 in that respect. Also, it can be gains from any property, not just like-kind property. So definition of a QOF, we've got the 90% asset test. So on the testing dates, QOF has to hold 90% of its assets in sort of good assets. And those good assets are the interests, so equity interests in an entity that qualifies as a QOZ business. Good assets can also be QOZ business property. And so we'll sort of talk about each of those in turn. On the testing dates, you'll measure the assets of the QOF, and you'll use the cost according to Form 8996, which is the QOF self-certification form. You'll use the cost basis of your assets to determine whether you satisfy that 90% test, unless the QOF uses applicable financial statements under Section 475, which is likely not the case for most real estate funds. So you're sort of taking a snapshot on the testing dates for 90%. It's the date that is 6 months after the first month that a QOF elects to be treated as a QOF, and then December 31 of every year. And then after that, it's every 6 months. So there is sort of potential to sort of manipulate that timing and make sure that you're holding cash until the day before the testing date, and then you sink the cash into your subsidiary entities, and you can qualify. So we'll talk about that a little later too. The penalty is based on the underpayment rate, and that's generally looked at on a monthly basis. So you snapshot every 6 months to determine whether you qualify. If the penalty applies, you're looking at the amount by which you failed to qualify on a monthly basis and applying the underpayment rate, or 1/12 of the underpayment rate each month, and the QOF will bear that penalty. Underpayment rate right now is about 5.5% for individuals, about 6% for corps. So let's talk about the QOZ business requirements. So this is generally, and we'll see in a couple of slides, generally because of the way these rules work, you'll have a QOF that invests in a QOZ business entity which holds the assets, and those assets and the entity constitute a QOZ business. So what does it take for a QOZ business entity to be a QOZ business? It has to hold substantially all, which is 70%, of its tangible property as QOZ business property. We got to 70% in regulations. I think a lot of people were pretty happy about that. That's sort of the main requirement in the real estate context. There are also a few other requirements. 50% of the gross income has to be from the active conduct of trade or business in a QOZ. We'll talk a little bit more about that at the end and how the regulations, changes to the regulations may loosen that up a bit. And then you have to have less than, the QOZ business entity has to have less than 5% of its assets be non-qualified financial property. So that includes cash in excess of reasonable working capital. So let's take an example. You have an investor who sinks $100 into a QOF. The QOF testing date comes up, so the QOF needs to sink its money into its subsidiary QOZ business entity. So it sinks all $100 into the QOZ business entity. And so now the QOZ business entity has to, at that time, qualify as a QOZ business entity, but it's only holding cash. So the regulations have the sort of safe harbor for working capital that has been designated in writing for the acquisition, construction, and or substantial improvement of tangible property. And that has to be spent over 31 months consistent with the written plan. There's some questions about whether that safe harbor applies to operating businesses as well as real estate. What I've heard based on what happened at the hearing is that the IRS seemed surprised that those questions were out there, and that the intent was that the 31-month safe harbor should apply to operating businesses. So TBD whether we see some changes to that currently written safe harbor or whether we see a separate safe harbor for operating businesses in future regs. So those are kind of the high points of qualifying as a QOZ business. And then the QOZ business property. So this is the sort of 70% rule. 70% of the tangible property held by our subsidiary QOZ business entity has to be QOZ business property. That's tangible property acquired by purchase from an unrelated party by the QOZ business entity, and that's a 20% threshold. And the original use of that property has to commence with the QOZ business entity, or QOZ business entity will substantially improve the property. So think QOZ business entity buys new computers, and the original use of those computers commences with that QOZ business entity, as opposed to buying a bunch of used equipment and starting with that. Or think QOZ business entity acquires a rundown building and rehabs the building, substantially improving the building. That building would also qualify. Just for the sake of time, we'll kind of move on to the next slide. This next slide with the QOF structures, you'll see what I was referencing earlier sort of on the left. Generally, because of the 70% test applicable to QOZ entities, you'll have a taxpayer investing in a QOF, which owns interest in a QOZ entity, which is a QOZ business. And so at the end of the day, you've got the 90% test at the QOF level. So it can put 90 of its 100 of assets into the QOZ entity. And then the QOZ entity has to hold 70% of its tangible property as QOZ business property. So a little more favorable than the structure on the right, where 90% of all of the assets of the QO fund have to be QOZ business property, which is tangible property acquired by purchase, and that meets the requirements we just discussed. So let's move to the next slide and talk about some of the timing rules and considerations here. As we mentioned, investors have to invest within 180 days. There's a special rule for partners. The measuring dates for the 90% test, generally 6 months and December 31. Kind of already hit on all this stuff. We've got the 31-month safe harbor for working capital that we also already hit on. And then the QOF self-certification, that is made with the filing of the QOF's tax return after the first year when it elects to be a QOF. So those are kind of the timing considerations.
And Branson, how are kind of funds dealing or addressing those timing requirements? Whether they're multi or single asset.
Yeah, so it's interesting to look at these rules, especially it's easier to see in a single asset context. Let's just assume we have an investor who kind of will control his own destiny and recognizes a gain through a partnership. So investor will have a captive QOF that will invest, say, in a single investment for simplicity. So just to give an idea of how long these timing rules can stretch out, let's assume the partnership recognizes a gain on January 1 of this year, 2019. The partner can elect to start the 180 days on that date, and the partner can invest in the next 180 days, or the partnership can invest within the next 180 days. But let's assume we don't make that election, and so the partner's 180-day period begins on December 31 of 2019. So within 180 days of December 31, 2019, the partner has to transfer cash that it wants to, in the amount of the gain it wants to defer, to a QOF. So that has to happen by June of 2020. And in June of 2020, the QOF, that will be the first month that the entity holding the cash will elect to be treated as a QOF. So the QOF now has to pass the 90% test on November 30th of 2020. And until that time, it can hold cash and be sort of in search mode. So the day before November 30th of 2020, the QOF transfers cash to a QOZ business entity. So that happens in November of 2020. The QOZ business entity on that date adopts a written plan and ideally already owns property and adopts a written plan to substantially improve that property, and then it has 31 months to do that substantial improvement. So that 31 months, you finish building this project in June of 2023. So you started in January 1 of 2019. You don't have to satisfy the 90% test until November 30th of 2020. So you have almost 2 years during which you can essentially get your ducks in a row. On top of that, the November 30th, 2020, the QOF transfers cash to the QOZ business entity. You think it's going to work out, but if it's sort of your QOF and this is a captive scenario and you only have yourself to consider, you can wait and see until September of 2021. So you think the investment's going to work, you're not sure whether because the rules are unclear or we haven't gotten the additional guidance we're expecting yet, you don't have to elect on the date that you transfer the cash. That QOF and the investor election to defer, those can happen as late as September of 2021. And all of this is resulting from a gain that started January 1, 2019. So the timing rules do allow for a fair amount of flexibility. It'd be better to have more because it's a little tougher to make all of this work in a sort of multi-asset, multi-investor fund context.
Hey, Branson, can I interrupt you just real quick?
Sure.
Yeah, we had a question about the slides. I want to just announce, if you want to refresh your screen, the PDF of this slide presentation should show up on your screen, and if we're moving too quickly for you, that way you have access and you can move at a slower pace or go back and look. But it will certainly be available after the presentation as well. So just wanted to let you know, if you want to refresh, it should show up on your screen. And then, Branson, you can go ahead to the next slide.
Okay. Current trends and issues. So as we stated, the rules work best for real estate. There's some uncertainty in the sort of operating business context, and they also work best for the safest investment is a single asset deal. So if I'm an investor out there, I'm looking for basically a development JV where developer is promising to, or manager of that entity is promising to qualify as a QOZ business entity, and we just hold the one asset, the hotel, the multifamily property, whatever it is. A lot more uncertainty there than in the multi-asset fund context. But to talk about the funds, the multi-asset funds, I was on a panel a couple weeks ago at an IPA conference in Dallas on OZs, and there was a representative of FINRA there who said at that time FINRA had seen 15 funds. So those were 14 Reg D funds and there was one Reg A fund. So the funds that FINRA would have seen are funds that are being sold by FINRA member broker-dealers and that have already made a sale. And so FINRA Reviews has the offering documents for that, and they're looking at this from a suitability perspective on those broker-dealers who are selling these. So 15 is a pretty low number given all the sort of discussion and excitement about this program. But that, I think part of that is attributable to the fact that that's just the funds that are being pushed by registered broker-dealers. And I think there are a lot out there where we're just seeing the issuer use this sort of issuer exemption. A lot of funds are, and sorry, I know we're at our time here, so I'll try to wrap this up within the next 5 minutes or so. A lot of funds are sort of the main challenge for a fund is you have multiple investors come in, and the fund, if you're traditional sort of private equity structure, the fund has multiple investments. But under the current rules, we have this rule that says to qualify for the biggest benefit of all, the 10-year exclusion, the investors have to sell their interest in the QOF. So you've got a QOF that owns 10 QOZ business entities, which own 10 different properties. And at the end of 10 years, this fund sponsor is expected to find a buyer of the interests of the investors in this QOF. So number one, you're selling an entire portfolio to one buyer. That could be challenging on its own. And number two, you've got to convince that buyer to buy the interests from potentially hundreds of investors. That's another big issue. So hopefully we get guidance that sort of allows an asset sale by the QOF, and I think it's not unreasonable to expect that guidance will come. In the meantime, fund sponsors are taking a close look, and what I think probably makes the most sense in the real estate context, if you can qualify, if you have sort of readable assets, is to make a corporate and a REIT election. Because a REIT or a corporation, unlike a partnership, can, after 10 years, adopt a plan of liquidation and sell pursuant to that plan on an asset-by-asset basis, distributing the proceeds. And the receipt of those proceeds by investors will be treated the same as if the investors had sold their interest to a third party for purposes of this 10-year benefit. So it's essentially a workaround for a REIT or a corp that is not available for a partnership under the current rules. Doesn't make a lot of sense that you would be able to sell the assets of a REIT or corp and not a partnership. Under the technical rules, sure it does, but from a policy perspective, I don't think it's a consistent result. So wouldn't be surprised to see guidance coming out that says partnerships can sell assets. But for now, if you're investing or sponsoring a QOF, I think you have to go forward under the assumption that you'll have to sell your interests in the QOF moving forward, which is a big reason why sort of single asset QOFs are much easier to work with and to get comfortable with from an investor's perspective than multi-asset QOFs. Let's see, just for the sake of time here. So we had regulations. I'll just talk really quickly about sort of the status of the regulations and a couple slides back, and then what we might expect in future regulations. We had regulations come out, proposed regulations in October. They can be relied upon. There are a lot of questions that remain even though we have these regulations. There was a hearing on February 14th on those proposed regulations. Some of the more popular topics addressed at that hearing, impact reporting requirements. So people are asking that, the concern is that these QOZ business entities and investments by these investors result in gentrification in these opportunity zones and push out sort of the current population. And really the whole philosophy behind it is that we sort of better the community as a whole, and not just gentrifying the community and pushing out its current residents. So people are asking for sort of impact reporting requirements. I think that'll be a big one in sort of determining the success of this program and whether it's renewed, is how QOFs are able to sort of track the impact of their investments and report on that. People are also asking for a grace period to qualify for the QOF to satisfy the 90% test. That will be important for sort of multi-asset funds with many investors coming in potentially at different times. If you're a fund sponsor and you've got cash coming in multiple closings, then under the current rules, you need to have identified your investment and you need to have a home for that cash potentially the very next day. If an investor comes in the day before your 6-month test and it puts you sort of over the 10% threshold for cash held, you need to deploy that the next day. So there's not a lot of sort of flexibility in that respect now, but that's being requested. People are asking for an exemption for interim gains reinvested by a QOF. So QOF owns an asset 5 years into the 10-year holding period. It sells that asset, but reinvests the proceeds, including the gain from that asset, into another OZ investment. Under the statute, the IRS, the Treasury is directed to promulgate rules that sort of allow that and facilitate that. Those rules are have yet to be released, but they're being requested. The 50% gross income test, which we sort of glossed over, there's a requirement that a QOZ business entity have 50% of its gross income arise from the active conduct of a trade or business in the QOZ. And so that in the QOZ portion is creating a lot of questions. That was added by Treasury in the proposed regulations, and people are requesting that be taken out because it's not a statutory requirement. Wouldn't be surprised to see that go. And as we discussed, the sort of another of the big topics discussed at the hearing was the ability of the QOF to sell assets on exit. So to be determined when the proposed regs are finalized. There is a second tranche of regs expected, and then a third tranche expected after that. The second tranche will likely sort of build on and address different and new issues not addressed in the first tranche. Sort of the second, and I think these are generally coming out in the order of importance. The first tranche is aimed to get at some of the gating issues. The second tranche will get at some of the issues that are important but not quite as important as the first tranche, and then the third tranche will look at things that will really only come into play down the road, like the impact reporting and the process for decertification of a QOF. So, know we went over a little bit, but appreciate everybody's time. Glad to sort of saw some questions come in. I'll take a look at those, and glad to discuss further with anyone out there.
Yeah, Branson, that's great. We did get some very good questions, and I know we're at the tail end, but let me just kind of, if we wrap it up, and if you ask the question and we don't respond to it, you'll definitely get an email from us separately on your question. But Branson, just for kind of big picture, we've got these timelines, clock is ticking. Some people may need to invest by year end. A lot of questions remain. Still need regs to answer some of these questions. So what should investors be thinking about? I mean, should they be comfortable investing now, or or if you're marketing a fund, like, can you go out and market a fund now? What's the exposure for managers if they, maybe they don't satisfy some of these requirements? Should investors be concerned about that if they're rolling over gains and investing in a fund, and maybe the fund has a foot fault or doesn't meet some of these requirements? I mean, just with a lot of these unanswered questions, how should fund managers or investors be thinking about this in the short term?
Right. So I think if you're going out there now as a fund manager sponsoring a new fund, you have to assume that we're working under the current rules. You can cross your fingers and hope that better rules come out, but you have to have disclosure that assumes the current rules apply. Investors have to understand that if there are uncertainties, they may not be resolved favorably by future rules. That said, I do think it's possible to raise a fund and a multi-asset fund, and people are doing it. And we're advising clients on it. We know enough, at least in the real estate context, for a fund sponsor to sort of responsibly market a real estate fund. There are some questions, but I think a lot of the questions there's only one really reasonable way that these questions could be resolved. And a lot of them are sort of, there's uncertainty and we're asking for clarity, but honestly, in the view of a lot of people, in my view, there's really only one reasonable way to resolve it. And generally, it's, in my view, you can make an investment work in the real estate context. So from an investor's perspective, if you're investing in a fund like that, I think you definitely want to have confidence in your sort of fund manager's ability to manage these asset tests and comply with all of these rules, and then react to new rules coming out. So you're looking at a fund manager not only from the perspective of can this fund manager choose investments and manage those investments effectively, but also can this fund manager deal with this uncertain and changing landscape, and do they have solid tax advisors, lawyers and accountants, and a fund administrator that knows what it's doing? That's important. Also, if I'm an investor and I see an opportunity for sort of a single asset deal, that's probably going to look a little more attractive to me than a multi-asset fund, at least from the perspective of just sort of the knowing that you're a little more confident that you will get these tax benefits. Of course, you lose the diversification with a single asset, but yeah, plenty of people are out there doing it. We want more rules. We'll get more rules, but there's enough now to make this happen in the real estate space.
That's great. Thank you, Branson. Sorry we went a little long today, but there's a lot to digest in this. Hopefully you do have the slides. If you don't, they will be available on our website to be downloaded, as well as the webinar itself. And then obviously, if you have questions, feel free to email Branson directly. He's happy to talk through or think through any of these issues you may be dealing with. We have a few technical questions that Branson will respond to after the webinar. Next week, we're going to look at state and local tax issues, so hopefully you can join us for that. Should be very interesting. Thank you, everyone, for joining. We appreciate your participation in the webinar, and we look forward to seeing you next week. Thanks very much.
Ladies and gentlemen, this concludes today's conference call. Thank you for your participation. You may now disconnect.